All right. Good morning, everybody. NVIDIA did it again, and they announced a 10-to-1 stock split. Awesome. At the same time, the Fed is now beating the drum higher for longer. I think they're being misquoted, but I want to come in and look. Higher for longer implies that they're not done raising rates. And if they begin raising rates, this market is going to go down. On the other hand, if they only mean they are going to remain at these levels for a longer period in time, staying high for longer, that would be different. I think they're just being misquoted at the moment, but we don't have to assume. We can come in and look. This is the CME Group Fed Watch tool. It's free. You don't need an account. You can just Google Fed Watch and you'll find it. We're looking at December. Our current rate is 5.25. If we look here at where 5.25 is, it's here all the way to the right. It's low, anticipating that there would be a cut between now and December. We can scroll down and see 5.25. The chances of us being at 5.25 have gone down. But if we look a little closer, there was a September cut being priced in. It was the highest probability thing, going from 525 down to 500 flat. We want to keep our eye on that September one to see if it's now going to start moving back in the other direction, if they're going to unwind this cut that they had been pricing into the market. We can see that here from a month out, a week out, yesterday, and where we are today. It's not changing to the downside yet. So as much as the Fed is beating that drum, they're still showing here, the market at least, is not pricing in that higher for longer message yet. That's what I would be looking for today. This could take the wind out of the sails of this boost or this breakout that we got from NVIDIA. So it was kind of a double punch yesterday. We were getting things from bank CEOs talking about how the things are more fragile now and the inflation still isn't going down, and how they don't see us getting a rate cut this year. And then Fed coming out with the FOMC minutes, and that also pointing to a discussion of remaining high for longer. Look for clarity in these Fed speakers over the next few days, and listen for the difference in that phrase, higher for longer versus remaining elevated or remaining high for longer. Just two different things completely. I know it doesn't seem like very much, but back in the day, the minor nuanced differences in tone, in words used, would move markets. And the Fed has tried really hard, and they still suck at it. They tried really hard with their messaging to be more clean, clear, succinct, and I think they're screwing it up a little bit right now. NASDAQ is up more than 1%. Japan is flat. Small caps at 0.25%. Still a divergence between the NASDAQ and the S&P this morning. I posted earlier, the divergence was, it still is about 0.4. So yeah, that really hasn't changed. It's still pretty wide. That's something I tend to look for when I'm looking for, which one of these are going to change. Is the S&P going to catch up with the NASDAQ, or is the NASDAQ going to catch down to the S&P? But those two generally run, relatively close in percentage terms. So it can be a nice little arbitrage play. We're going to get some jobs data. This isn't the biggest jobs data. It's just some jobs data. It seems like this number hasn't moved in a long time. not really expecting much of a change here, but that is where the market can really move. Remember, it's shock and awe that can move the markets. When everybody assumes they already knows the answer, and then we get something that is outside of what they expected, everybody is now off sides, and then they all scramble, and that can move markets really fast. So don't be complacent on this 8:30 initial jobless claims, because if this number is off, then the market's going to move because of that. It's not like we're going to crash and burn or anything like that. It'll just be a very fast, very sudden move. And then, of course, we'll rebalance and everything will be fine, but just don't get caught flat footed on that one. We also have PMI services at 9:45. Uh, I have a little phrase that I talk about when it comes to the S&P and breakout days. And my approach to this logic is, if we have not started to break out and run by 10 a.m., then we're likely not going to until after lunch, barring something like news or some other exogenous event that kicks us out of the range and gets us moving. So I'm looking for those breakouts in the morning after we open to really show us that it's there by 10 a.m. If we open and we set a range and we stay in it until 10, we're very likely not going to do much more than that until after we get into lunch. Days like this, where we have PMI services at 9:45 or we have news at 10, those are the kind of days that can break that logic. Same as yesterday when we get on Wednesdays the petroleum report at 10:30. That can break that logic. But that kind of goes back to, what I said. If we haven't broke out by 10, we very likely won't until after lunch, unless something happens like news. That 10:30 news would be the thing that could kick us out of that range and get us moving. So the time frames today are just a little weird. We don't generally get a 9:45 report. This does highlight, though, watching the clock. Half hour and full hour is the ones that I talk about most often. But as this one shows, we can get reports on the quarter hour too. And if you go in and you look at your stock chart or your futures chart, set it down to a 1 minute time frame and look at quarterly hours, just quarterly hours, and look at the flood of volume that comes in on that quarter hour candle. It's from events, different events. And of course, it's not every single 15-minute candle, but if you're trading on a very small time frame, 10-second charts, 30-second charts, using tick trades, some of us trade in points, some of us trade in ticks, then, avoiding getting run over by event volume on a new 15-minute candle would probably help you out, or play the flow, right? Take it either way. The last PMI, when I went looking for it, had actually done better than the consensus was expecting. So maybe we'll get some good news. The thing now, or at least the thing right now, is to be asking, is bad news still good news, or is good news good news? Is good news bad news? What is it that the market is wanting to see here? Deteriorating economic conditions enough that would force the Fed's hand and make them cut, or continued, quote, good conditions, the no landing scenario where everything is just continuing to hum like a well-oiled machine and there's no reason for a cut. That's really where we're at in the question phase. Of course, everybody who wants that cut has to face the reality that the Fed's not going to cut unless things deteriorate. So bad news would be good news. But we don't know who's the dominant camp here in that argument. We are going to get the 10-year today. I really like the 10-year auction. I know we're not supposed to have favorites, but I really like the 10-year. Watch the clock. 11 o'clock, 11:30 and 1 o'clock, we're going to get auctions. We got Bosick out there chipping teeth this afternoon at 3. And we're going to get data out of Japan tonight. This is the ES on a 30-minute chart, and this red line is R1. If you look at pivot points like a floor pivot, above the floor pivot you have 3 R levels. R stands for resistance, and below the pivot point you have 3 S levels. S stands for support. Generally speaking, if we open gapped up and are above the R1 level, then R1 will act as support and the market will continue to move farther away from this gap that it has created. Now, what I just said applies to RTH open, not Globex open, because we didn't open in Globex gapped up there, right? We opened and then we ran up there. We have an inside day breakout, an inside week breakout, and that inside week has acted as support, or last week's high acted as support. We have this beautiful Busby shape here now. But R1 has acted as support, and it's supposed to. This is like straight out of the textbook. If I was looking for examples of a gapped up market opening above an R1 and fading down into it for support, I couldn't have found anything better than this representation here. The only thing that's missing is that it's not RTH yet. So we still need to go into the RTH, the regular trading hours, but this is a textbook example of price using the R1 as support and not closing this gap. And I'm not saying that we can't. I just mentioned all the economic events that we have on the table today. We could still fall down, break R1, and get the gap closed. But the fact remains that when we open gapped up, there's always this question of how big is the gap and are we going to close it? A lot of analysts and all the textbooks will tell you if the gap is too big, it very likely won't get filled that day and that we'll just continue to widen the gap. But how big is too big? And how big does it have to be for whatever market we're looking at? Because X steel is going to gap up way differently than Apple is, and Apple's going to gap differently than the ES futures will. So how do we define how big of a gap is the gap before it's too big? Using the R levels allows us to define that distance. Another thing worth noting is the narrow channel for the pivot point. This isn't as narrow as I would like it to be. It can be so narrow that you don't even see the yellow lines at all. They're just buried inside the purple. That's how narrow it could be. So this is narrow, but it's not the most narrow. A narrow pivot point channel like this implies that today could be a trend day. There's a lot of pre-market things that we can look at to kind of give us a bias for what kind of day should we be expecting. A range day, a trend day, a sideways day. Range and sideways is not the same thing, right? A range day is not a sideways day. They're completely different. But there are a few tactics that can help us try to anticipate the kind of trading day that we're going to get. And one of them would be a narrow channel or not. This is narrow enough that we could anticipate a move today. There's also the impact from NVIDIA if it can continue. Spot Gamma did a write-up on NVIDIA. They have a NVIDIA case study from March 14th, 2024 that I'm going to share with you guys. I've seen it on finance juice too. So you might be able to get it there, but I'll post it in chat. You can take a look at it. I'm still waiting on Spot Gamma's AM report. I don't have that yet, but once they come out with it, we'll share it. That way we can better evaluate the optionality levels around the futures. So I mentioned a Busby. A Busby is my own little phrase for when a market is in a range and it finally breaks that range. The textbooks will tell you that when a market is in a range and it finally breaks the range, it very often pulls back to that old resistance and it checks it to see if that old resistance will act as a support level. And we can see that when it does things like this. So it finally breaks out after fighting against a range over and over, comes down and bounces. That is what I call a Busby, because I just got tired of saying old resistance becomes new support, price breaks out, and it'll retest. Some of the best trends that you'll ever find, if you track them back to their starting point, they were in a range. And if you think about Wyckoff and accumulation and distribution, with where price would fade down over time, days, months, weeks, whatever, and then it builds a base along the lows before it works its way back up. That basing down here, that range, when it finally gets broke out, very often price will break out, retest, and then continue on. This point right there is what we have to be concerned about. The reason I bring it up is when I was first teaching people about Busby, I mentioned how it's usually the start of a trend and how you can use this bounce as an entry point for a trade. And everybody just took that to believe that, oh, well, this is just a trade setup. This is really great. And everybody tried to play Busby's for a trade. You can, especially when they're really big like this. But generally, when we get a breakout, especially intraday trading for the futures, it's a much smaller breakout. You know, it comes up a little bit, it comes back down, it bounces, and your distance is only back to the top. That's all that it owes you. Well, if it's a 5-point move, then you're trying to nail it perfectly from the bottom to the top. And how often do you think you can hit tops and bottoms every time you try to trade? You want more room, right? So you don't normally get this really big, wide, beautiful shape like we have here. But still, either way, it only owes you back to the top, and we're there. Once we get through that top and we continue to go to the upside, then hey, great. Now we're starting to get to that trend point of the whole thing. So I don't know it's going to be a trend. The point is that trends very often start after being in a range. Price very often will break that range and retest, giving us a Busby. We've got a classic, beautiful Busby right off of the R1, just like it should. And we can now do things like just measure this pullback, plot those levels higher. We still got R2 and we have R3. But even outside of those R levels, we've got just what I measured right there, which we can plot 50% and 100%. And if we need to, we can do it in both directions. So upside and downside moves. We need to close, or we need to go into the open above this R level. I'm also going to point out that this R level is 53.50. That's a options level. I've looked at Spot Gamma. I looked at Mentor this morning. Neither one of those have 53.50 as an options level, but it's still an options level. It's a round number. It's a quarter level. 53.50, 53.25, 53.75. You want to always pay attention to those numbers. So this is support for a number of reasons. It's last week's high. You know, it's this week's high. It's the round number, it's the R1 level. You see how we just keep stacking more and more things here that it is. Still doesn't mean we can't break it. So, just continue to keep that in mind. Looking at the daily on the S&P, the range that we've been in, that I've been highlighting constantly, was Thursday's high and Friday's low, right? That was the range that we've been discussing all week. This is IX10. Now, technically, IX10 is supposed to be inside of one single candle. And I could have backed this up and we could just use Thursday, because that little dip that we had outside of it on Friday is just a wick. Some analysts will use only candle close. Some will use wick to break an IX10. I use candle close. But staying inside the range for that long, and now that we finally broke out, this could be a pretty good size move. Just need the follow through. So again, we can measure this range. If this is the range that we're focused on, the concern is 53.70. Notice that this range, by the way, is almost perfectly yesterday's range. The number didn't change. It's still 53.70. That's another overlap, right? So we've got 53.70 as a significant level of resistance from two different sources. We've also got this really big monster candle back here. We can plot that 50% and we get 53.70. Yeah, I'm moving 2 points off there, but you know what? It's still a significant level of resistance at 53.70. So as we continue this move to the upside, keep your eye on another 10 points higher at 53.72, 53.70. It's going to be a significant level of resistance. Eight 8:30, 9:45, 10 o'clock, 10:30, 11, 11:30, 1, 3, and 4. We've got something all hour, every hour, all day. It's going to be that kind of day. The thing what we're looking for is anything that can throw a monkey wrench into the bias that the market has right now. We are above the volatility trigger. We're above 0 gamma. We're above all of the major moving averages of note. The call wall is completely out of our way. The only thing that we are hitting at the moment is the ATR level. So ATR, nothing fancy or complex about this. These ADR levels I came up with because of math, basically. If you've ever tried to use average true range, it can get a little complicated on how they define the average true range. And I wanted something that I understood the math in. Well, just a simple average makes perfect sense to me, right? If you have 10 numbers, you can add all 10 together, divide by 10, and you've got an average. Pretty simple. It's not complicated at all. So that's what I wanted, and I made this ADR using that kind of logic. ADR, average daily range. It's looking at a daily chart, and it's asking on a day-to-day basis, what has the market done over the last 21 days? How far has it moved from its highest point to its lowest point? Add up the last 20 days, divide it by 20, and tell me what the average is. And that's what this gives us. The average is about 0.93%, almost a 1% move every day. Well, if you think about where we open in Globex, we could go up an entire 1%. That'd be the yellow line. We could go down 1%. That'd be the yellow line on the bottom. But what if we go 1% in total? 0.5% higher, 0.5% lower. In between those two, it is our 1% move on the day. If you look at what we've done since Thursday, we've moved 0.5% higher and lower through all of this on average. We've already made that 0.5% today. We're at the ADR half already. If we get to an ADR level really early in the day, it opens the door for us to go to the other side of the ADR by the end of the day. That's something to really think about. Now, we got to the ADR last night. And here's another really neat thing about these ADR levels is if we get to the red ADR and we pull back away from it, but we don't go visit the other side and we instead come back to the ADR again, we very often will go ahead and pass on through it and we'll go to the other side. We'll go to the other ADR level. So we've got a lot of technical signals that tell us we're going to go to 53.88. We've got a lot of analysis that says there's some really solid support underneath this. Unless we get some news or, some data that breaks all of this down, this should turn into a really nice trend day. The volume looks really good. We're sitting at 86. We've been seeing, volume days with 56 and 43, 44, 64, 61. So 80 looks really good. 86 looks great. Shows that participation. And look, going back, we got 40s and, sure we had a 70 there, but volume's been light. Keep an eye on that sizzle through the day, see if it picks up. 10-day, 30-minute volume profile with TPO. We're going to lose more of the bottom of this profile as the week goes on. But if we continue this move to the upside, then we're not going to see a narrowing in this channel. We're still going to expect it to expand. This air gap down here, this air pocket of risk, doesn't seem like we're going to revisit this at all. As long as this breakout holds, obviously, and we continue to the upside. My concern is the raid and draw discussion that we've had recently. If this is our range, which was the draw, and if this is nothing more than a raid into liquidity, then they're just gathering up liquidity before the move, which we would then expect them to see a break of 53.11 cog line, a drop through this air pocket down into 52.50. There's nothing on the radar that suggests that this is what's on the table, just bringing it up. Mapping out the 5x5. If we look at what was going on yesterday with these VPOC lines that we had, as the day went on, there was our first touch. This is a really great example of why we carry forward these points of control. So we call this a first touch play. Of course, that didn't hold and it was broke. We came down and hit the other level because we had an older one down here. That one also wasn't able to hold the line and it was broke too, but it just a really good example of why we keep these. So this one's done, and this one is done. We don't have one for yesterday. If we were to lay one on here, we could see it's already been hit. So there's nothing to keep there. Yesterday we were talking about the P-shaped profile that we had, and I had mentioned that it was bullish. And of course, at the time, price was sitting all the way down here because we had just fallen, and it was just a nice, clean. It was a really nice, clean profile. None of this extra volume was really here because it was just that first tail all the way down. And the discussion was that we very likely wouldn't keep that shape, that it was bullish. The P shape is bullish. We would rally back up. We would build out this volume, and that we would end up with a D or the double D, which is really a B, but the B is the double D. The main thing was that the volume never showed up down here, right? Like hitting an iceberg or anything like that. And I guess a nice small example of that would be today. If you look at just the overnight volume, all of this volume down here at this low, we didn't spend, a significant amount of time at this level, but we got a pretty decent amount of volume down there all the same. Nothing stands out on today's volume across these highs with TPO versus the volume profile. Everything looks fine. There's really no shape of concern, no imbalance or distribution worth noting and pointing out. The initial balance was immediately broken, and it's been a really nice expansion. $53.84 is the weekly expected move. This is how far we expected the market to move for the entire week. A lot of times we'll make the entire week's move in a single day. We didn't yet. We didn't this week, so we won't. But we can hit the edges of this. Another thing about this box is that we tend to close inside the box 80% of the time for the S&P. Now, technically, this is a one standard deviation. We should close inside of it 70% of the time, but the S&P is the most accurate expected move product in the marketplace, and it tends to do it at an 80% accuracy. The thing is, when it doesn't do it once in a while, it's fine. Like once in a while, it's no big deal. But when it continues to break and close outside the box on Friday repeatedly, again and again, then it's a big red flag warning that something is wrong. And I want to continue to pound the drum on this. Have you seen the VIX lately? Because the VIX is sitting at really low levels. And yet the S&P continues to be so violent and so volatile that it's breaking its expected move repeatedly and closing outside the box over and over again. Last week, Friday at the close, we were outside the box. Same with the week before that, we were outside of the box. So that's 2 weeks in a row. We only need to count back 10 weeks. And if we find more than two that closed on Friday outside the box, then we're outside of our norm for accuracy. Here was another week where we closed outside the box, and here was another one, and here was another one. So there's 3 weeks in a row, and then 2 weeks here. We won't even count the current week because that wouldn't be fair, right? The week isn't over. So 5, 6, 7, 8, 9, 10. Since the new contract change, and here's another one where we closed outside the box at the end of the week. 6 out of 10 I can do better than that by flipping a quarter, right? We could just roll a dice and try to pick levels better than using this thing. This is showing that there's a lot of volatility, that price is moving so strongly and so far that it's breaking its expected move ranges on a weekly basis again and again and again, and VIX is at low levels. It's very dangerous. The last time I seen this sort of behavior was right before COVID. Now, I'm not saying that there's some global pandemic and that everything's going to crash and burn. I'm just not that kind of doomsday analyst, perma bear kind of person. I'm just highlighting that there's some really strange things going on here, and that this is a warning that you kind of want to pay attention to. So, if you're holding a lot of long-term stuff, if you're like me and you swing, I've got my retirement accounts, my long-term accounts, and then I've got my shorter-term swing trade stuff. I've reduced a lot of my longer-term holdings in things. And that's usually the mutual funds, the sector ETFs, those sort of things. I'm not out of everything, but I've reduced quite a bit because there's something up here. Could be nothing, but many that many breaks in that period of time, coupled with the really low vol, just makes things a little dangerous. So we're still above the 10-day at 1.1%. The average on the year has been around 1.5. So we're doing fine on that. We actually got this new print, right, where we got almost 2. So things are still looking good on that front. We have not moved too far, too fast. We're not overbought. It doesn't owe us a pullback or anything like that. If we look at the distance from the week, this is the 10-week. We're sitting at less than 3%. So we're getting back into our norm. Most of the year has been spent somewhere between that 2 and 4% distance from the 10. So we're just getting right back into the groove again, right where we would want to be, not overbought, not overextended, not due for a pullback because of the distance that we've traveled, nothing like that. No mean reversion, linear regression, least squared methods, dot plot statistics, nothing like that. And the VIX is down again. $11.61. That's amazing. Bond volatility also really falling out of bed too. Skews creeping back up. All right. Skew can be really confusing for people. I like to, lay it out in a simple concept. Um, the simplest way to say this is traders' expectation for a two standard deviation move in the market. And I know a two standard deviation move that like what the heck is that, right? If you talk math and if you're a nerd, then you understand that completely. If you don't, then I'll just show you what it looks like. So just to keep that chart where it is, we'll put this back on ES and we can just go to the Analyze tab. I'm asking a little much out of Thinkorswim here. Come on, you can do it. So on the Analyze tab, we have up at the top the ability to ask it for a range. This is two standard deviation right there. So when I do that, and now I scrunch this up a little bit, we can highlight or show where a two standard deviation move is. Let's just add some price slices here also as well. Base means current price, and then a two standard deviation line to the downside and the upside, right? So it's going to be like that this morning, I see. Let's just put something in there. All right. This distance in gray here is a two standard deviation move. That's 5-5-3-5 to the upside and 5-2-0-8 to the downside. Just get rid of that one in the middle since that is price, and we could put that right on the chart. It'll just lay it out there for us. Those two lines. So when we look at a skew chart, it's really trying to ask what the market is thinking. What's the expectation that we could get a move in the market, two standard deviation, high expectations or low expectations? So when you see skew climbing, it means traders are more concerned or have the expectation that we could get a two standard deviation move with a greater expectation. It's fear, right? It's just it's what's standing out. Now, skew, like I said, can be complicated. I can run you in circles of a million different things that we could talk about with skew, but that's the expectations part's what I wanted to highlight. And it goes right back to that weekly expected move too, because a weekly expected move is a one standard deviation. And if we keep breaking outside of it, it's because we're doing more than a one standard deviation. VIX is really low, and yet people are concerned that we're going to get an outsized move from something. No surprise, semiconductors are up. The FANGs are up, or the MAG 7. Nat gas, tech, growth. We can see multiple growth ETFs this morning that are up. And then kind of lagging behind, but are close to the line. Uranium, what I would be kind of encouraging people to look for today is a rising tide scenario. We don't want this move to be carried on the back of just growth alone, or at least not the Mag 7. We want to see it start to spread out into old tech, junior tech, just building materials, industrials, more utilities, as if that move hasn't been enough. Pot stocks, China ADRs. We want it to spread out. We can see we got pot stocks and nat gas, solar, which I mean, solar was just crazy yesterday. Even agriculture, DBA is trying to shake off that move, right? Try to come back around. So let's get some Bitcoin in there. More small caps. We can see IWM is up 0.5%. Let's look for this thing to spread out. And if we're going to get one of those trend days, one of those real runners, then we want to see a really high advanced decline line. On Thinkorswim, you've got kind of a fancy one that has money built into it. You can go to Market Watch, visualize, get rid of the heat map, and go to index. From here, choose your index, and you can choose more than one. These are detachable. So you can put, the S&P 100 in here, the NASDAQ 100 on another one. You can do the Mag 7 in another one. You can just stack these things up. But if you look at them close, it doesn't just have issues with your companies. This is the S&P 100. It has 101 companies. So issues are companies. We want to see 95 to 97 names advancing if it's going to be one of those days. Obviously, we can be bullish on days where we even have just a 60-40. It doesn't have to be that strong. But if we're looking for one of those real ripper days, then I'd want an outsized balance on the advancing names, because that'll show a broad market participation with a rising tide lifting all the boats, not just a few speedboats out there buzzing around. But it also has the capital in it. So it allows you to look for divergence. If you have more issues advancing than declining, but you have more money going out than in, then it kind of gives you a heads up that maybe the money flow isn't, supporting the advanced decline line. Otherwise, watch the news and take advantage of the move. Everybody be careful, be safe. I'll see you.